And we're going to we're going to try to cover three topics today. The first is going to be one that probably is near and dear to everyone's heart, which happens to be ESG and shareholder activism. So I will pick on Joe to start. He gets first up. Over the past few years, ESG has been the foundation of shareholder activism. What do you see as the broader ESG pressures on electric and gas utilities from their key stakeholders, such as banks, in response to regulatory, shareholder, and other pressures on those institutions?
Sure. Thank you very much. The first thing I would like to say is that EEI has done a great job of working with the Wall Street banks on ESG matters. There is a template on ESG disclosures, which includes carbon intensity, et cetera, which has been developed with the banks and with EEI and their member companies. I would say I would break the stakeholder side of ESG into really two components. And I'm going to focus here really more on the Wall Street bank element as the key stakeholders. The first is simply credit implications in terms of changing business models, acceleration of coal retirement, question about longevity of the gas LDC business in certain spots. The bank's regulators are focused on the credit quality of their portfolios, also are focused on the type of information that the banks are receiving and the questions and dialogue they're having with their clients. That is really, I think, primarily driven by the banks that have large financing and capital raising businesses. The second part of this, which is, I think, more interesting for the sector as a whole, is how the stakeholders of those big Wall Street banks are approaching ESG. And for that, you really probably can read carbon intensity and commitment to what our folks like to describe as the science, which you can shorthand for the Paris Climate Agreement. I think each of the banks that have large financing, capital raising businesses have adopted or are in the process of adopting policies. Some have said they won't finance oil and gas exploration in the Arctic, for example. And the focus, I think, initially is really on coal-fired generation. And the focus is going to be on, for the regulated utility sector, most companies have put forth 2050 plans. They have guideposts between now and 2050, and most companies are accelerating the guideposts. The banks are going to be under tremendous pressure to hit that net zero carbon neutrality in 2050 and to hit the guideposts. So I think for the US companies, the question will be how their own targets, which are going to be largely governed by either federal or state regulation, correspond to the pressures that the banks are seeing from their regulators, also from their stakeholders and shareholders. I would say that for the regulated utilities, this will probably result in conversations, et cetera, but not be a huge dislocation. I think the interesting question will be how this plays out outside the U.S., where there's greater coal intensity and the disclosure available to the financial institutions is quite different.
Thank you, Joe. George, do you have anything to add to that?
The only thing I'd say is that utilities have needed to focus on stakeholder issues for time immemorial. And for the outside observer, they're probably just underappreciated in terms of their skill in this area. And so it's an emerging area, but I actually think it's an area of strength for the utility industry, given the ratepayer interfacing nature of the sector and the need to work in communities.
Jeff?
I agree with that. It's been an evolution, and we started talking about carbon 20 years ago. And this sector in particular was most impacted by NGOs and environmental groups in those days, and now it's become mainstream across the entire constituent, shareholders, regulators, activists, as Joe described. So this is here to stay, and we need to figure out if we can quantify its impact on shareholder value going forward.
Thank you. All good insight. Next question, we'll turn to George. What are the transactional implications of ESG focus on the gas LDC business? I know Joe touched on it a little in his answer to the first, but love to hear your thoughts on that specific question.
The first thing to say before I touch the transactional implications is, at least at our place at Lazard, we see this as an enduring business. There isn't a technology or a solution that is, in our judgment, practical to displace the gas LDC business. There are opportunities to supplement what gas LDCs have historically done through renewable natural gas and maybe over time hydrogen. But this idea that this business is going away is not an idea that we would subscribe to. For transactional implications in the area, we'd say potentially more opportunity for transactions because, for example, electric companies ought to be evaluating their position in gas LDCs because they trade a little bit differently now. The perception around them is different. Valuation levels have been affected because of the uncertainties in the business, and we'd expect that to continue and be affected by concerns around the business. And particularly in some of the states, so a lot of criticism of the business and concerns around the growth prospects around new construction and conversion of customers to natural gas. There is the potential for this business to be more in the hands of private capital if there's a lot of noise in the public markets around this business. And taking into account the total market cap focused on gas LDCs, you could see private capital winding up owning these businesses because of their enduring nature, their cash flow profile, their yield. You could see someone in the sector who is a gas LDC or owns gas LDCs taking a point of view that it's an enduring business. The opportunity to acquire these assets is better now because prices are lower, and they decide to be a scale-based company going forward and conclude that scale is going to be very important to engage with stakeholders and also to deal with technology change. And then Joe just alluded to this a little bit, but another transactional implication is that with the noise around the business, cost of capital is a little bit higher, so financing costs around a transaction should be higher. But that's a collection of thoughts I'd have on that. Really good question.
Jeff or Joe, do you have anything to add to that?
I generally totally agree. I think it's a business that the death of the LDC has been way overstated. I think the multiples historically may have been too high. I think people's perception that that FERC was going to continue to have premium returns for some of those asset categories was probably overly valued. But the other point that George makes, I think, is there's only nine publicly traded of any size, and so it's not a large part of the total capital in the space. And we do believe as well that likely to be consolidated or part of something else to get the scale benefits in the space.
Yeah, the only comment I would add to that is that while I do think there has been some pressure on valuation multiples, I mean, 5 or 6 years ago, these companies were trading at M&A multiples. Now they're trading, kind of where the SMID electrics are. I think some of that is a function of the ESG matters. I think a lot of it's also just a function of the size of the market cap of most of these companies. They're relatively small, and the SMID electrics are suffering some of the same points in terms of PE multiples.
Thank you again for those insights. We're going to quickly touch on Larry Fink's most recent letter to CEOs. He recently came out and set a net zero target of 2050. Jeff, what do you think that's going to do? What effect do you think that'll have on utilities and power generation?
Yeah, well, we talked a little bit about it. Look, Larry's obviously well respected, and his letters are read widely, and he's certainly one of the largest investors in the world. So, I think CEOs and people in industries take it to heart. But I would concur with George's earlier point. I think this industry's done a very good job of getting ahead of understanding their carbon footprint, understanding what mitigation measures are realistic, and many of which have already come out and made commitments to 2050 or sooner. I think the question always becomes, how realistic is it to be at net zero by 2050? I think the target is certainly become somewhat accepted. It's going to be a function of technology and storage, how we deal with intermittent resources as those continue to be a larger piece of the portfolio. It's going to be a function of timing of electric vehicles and electrification of transportation in general. But I have no doubt that the largest investors in the world are doing more screens on ESG, are more sensitive to it, and are going to have an impact on governance, whether it's management teams or boards, being sensitive to how quickly they're able to get to that target.